This hits a bit harder because there's a cotton plantation right behind me and a sugarcane plantation in the distance. By 1860, enslaved people represented $3 to $4 billion in asset value, the largest concentration of private wealth in the US, and the financial techniques developed to leverage their bodies helped shape modern markets. But to understand how, we have to go back to the Virginia colony, where in 1662, a law made the status of a child follow the mother. It wasn't always this way, turning enslaved women into self-reproducing capital and allowing lenders to calculate future human collateral. And by 1705, it gets worse. Virginia law formally defines enslaved people as property attachable for debt, they're inheritable, appraisable, and seizable. While Spain and other European countries enslaved people, what made this British system unique was that British colonial law treated enslaved people as fully alienable chattel within this contract-enforcing legal order that prioritized creditors, inheritance, and market liquidity. This meant that enslaved people could move through the same legal channels as land, livestock, or financial claims. Combined with Britain's advanced bond markets, this property absolutism allowed human beings not just to be traded, but to be systematically integrated into scalable, legally enforceable credit systems. Now, the escalation comes in the 1830s when institutions like the Union Bank of Louisiana pooled plantation mortgages secured by land and enslaved people and issued bonds backed by those pools. They marketed them through New York houses such as Prime Warden King and London firms like Baring Brothers within broader Atlantic capital networks that included Dutch bankers as well. European investors purchased securities whose underlying collateral included enslaved human beings. These slave-backed credit structures continued into the 1850s and were still active when the Civil War began. Emancipation didn't just free 4 million people, it annihilated the collateral base of an entire financial system. A lot of banks failed and the bonds collapsed, but the architecture, the concept of pooling income streams, slicing risk, and distributing exposure to distant investors, that all survived, and that powered railroad finance, industrial securities, and eventually the modern mortgage-backed markets that destroyed the capital system in 2008. The assets changed, but the structure endures.